Hello, everyone. My name is Shareesa Jones, and this is my oral presentation on closing entries. Closing entries are just journal entries that are balanced and closed out at the end of the accounting period. When you think about closing entries, you just have to think about temporary accounts that are on your income statement that are going to be transferred and moved over to your balance sheet. Um, Closing entries allows for accurate tracking and guarantees that the temporary accounts start with a zero balance. Okay, that's the main purpose. Also, the purpose of the closing entries is to balance out the accounts to zero, which prepares for a better, which helps the company prepare for a new fiscal year. Okay. Some examples of your temporary accounts would include revenue accounts, your income summary accounts, and your dividend accounts. Your permanent accounts would include your assets, your liability, and your equity. Okay. Now, when you're looking at your income statement before anything is transferred over, you will see where your revenues are debited to the income summary, but the expenses are credited. This allows the accounts to balance out at zero. Okay. Also, when you're transferring those temporary accounts, you transfer them from your income statement into the retained earnings account in on the balance sheet, which is a permanent account. Okay. Um, your retained earnings is just a business's profits that they hold for future use. Okay. I did create a visual as an example to just show a trial balance that starts at the beginning of the year, January 1st, where we start off at the top with with our cash and accounts receivables, property, plant, and equipment. All of those fall under your temporary accounts, and your temporary accounts are accounts that are debited. Okay. For your permanent accounts, you will see on the trial balance where it includes the accounts payable, your salaries payable, accrued expenses, retained earnings, long-term loans. All of that falls under the permanent accounts, which are credited accounts. Okay. They do both have to balance out at the end, or once you add all those up, they should equal the same for them to be able to balance each other out. We credit the right hand side of each expense just to reset all of the balances to zero. Okay. We'll debit the left hand side of the income summary to get the new balance. Okay. Again, the purpose of this is to just reset all of the account balances to zero to just help a company prepare for the new fiscal year. And this is done on every year on a year-to-year basis. And at the end of the year, December 31st, when you're coming down to make your closing entry, you would just debit your income summary account, and then you would credit your retained earnings account. Okay. And then that would just balance those out and where they can reset, and then we'll be able to have a better, clear picture of the new fiscal year. Thank you. And this is my presentation on closing entries.